Hello everyone, welcome back to Upside Down Data. In this video, I'm going to explain why I'm cautiously bullish on Bitcoin here. So if you guys like the content, subscribe to the channel, give the video a like, and follow us on Twitter. We put out regular updates there about our risk indicators and more. So I'm going to be walking you through a few indicators from across different sectors of the market that are showing some confluence here and providing a reason for optimism, in my opinion. This is not financial advice. I do not know what's going to happen. All we can do is play the odds. But one of the best ways to do that is to look for confluence. And so that's what I'm going to try to do. The first thing that I have up here, as you can see, is the weekly chart for Bitcoin. This is, and you can see that it's been a bearish month and a half. I mean, we are about to close the sixth red candle in a row. This has only happened once before in Bitcoin's history. Back in 2014, there were 6 red candles that closed in a row, and that was part of an extended bear market. I mean, there was a bounce after those 6 weeks back in 2014, but then the price continued right, on its unhappy way to the downside. So that's the only precedent that we have for 6 straight red weeks in a row. And unless we get a really significant bounce in the next 28 hours or so, we're going to see that come to pass. So what do we make of that situation here? The reason that I have this channel drawn up on the chart is that, in my opinion, this is the most important trend line in crypto. The lower bound of this upward sloping channel, which was first tested back in January 2021, and has been tested repeatedly over the subsequent, almost year and a half now. In summer of 2021, tested repeatedly, held before ultimately bouncing and moving back up to test the upside, the upper bound of this channel, and then coming back down in the very beginning of 2022, retesting it on multiple occasions, bouncing up toward the middle line through this upward sloping channel and then coming back down to retest it. And now we've seen that exact same thing happen once again. So, one way to look at this, and I think the right way to look at this, is that the macro structure remains intact. As long as on the weekly level, this trend line continues to be respected, the status quo continues to hold. So as bearish as it feels, it's important to keep this structure in mind. What would be bearish here would be to see the price of Bitcoin break through the lower bounds of this channel and put in a weekly close below this level. This is right now at about 35.3, 35K and 300 or so. That number is going to keep moving up, monotonically week after week. And so we would want to see the price grind up from here in order for this macro trend to stay intact. But a good rule of thumb is that you want to get bullish at support and bearish at resistance. And this is the opposite of our natural psychological tendency, because in order to get to support, you have to endure some pain. We've had these 6 red candles to the downside, and now we've found support. And the question is it going to hold? There's no guarantee that it does, but at the very least, this is not the place to get bearish. So this is really the first and most important indicator that we need to keep in mind as we're trying to, play the odds here and figure out which direction is most likely. But it's not the only indicator. So I also want to talk about a few other things here that are important. One of which is the US dollar. So we'll look at that next. Another of which is the NASDAQ, which is highly correlated with Bitcoin. Bitcoin really follows the NASDAQ to a large degree, especially during bearish times like we've been in over the past few months. And we'll also look at the stablecoin dominance, because that also gives us an indication about market participants' willingness to get skin in the game. So let's take a look over at those. What I've pulled up here is the weekly chart for the DXY. This is the US dollar index. I'm just going to get my face out of the way to make sure that you can see the chart clearly. This is always extremely important to watch when we're trying to get a sense of the performance of risk assets like equities and crypto, because the US dollar is negatively correlated with these risk assets. When the US dollar is performing well, it means that people are selling their crypto and their equities for US dollars. They're holding cash. And when the US dollar declines in value, it means the opposite, generally speaking, that people are spending their dollars on assets that they expect will go up in value. The DXY has been in a parabolic move now for quite some time. This actually began almost a year ago when it bottomed in late May of 2021, and it's been in an absolutely explosive uptrend ever since. And that's only accelerated over the past few months as the risk markets have really gone into free fall. What's interesting, though, is that it's now testing and potentially appearing to struggle a little bit with long-term resistance levels. If we go back in time a little bit to the last time it was up at these levels, the first most recent time it visited close to this level was in March of 2020 when we had the COVID crash. We saw the value of the dollar spike then, although it quickly reversed to the downside. It got rejected off of the 103 level, and that coincided with a massive explosion in the price of Bitcoin and equities and risk assets that was a really good time for all. If we go back to the previous time, that's all the way back in late 2016 and early 2017 that the DXY visited the 103 to 104 level and got rejected off of it. So this is now the third time in the last several years that the DXY has visited this level. It's a really critical level, and the fact that it's occurring at the same moment that the price of Bitcoin is revisiting the support, its trend line support over the past almost year and a half, is significant. These things are both happening at the same moment. So we're seeing these two critical levels being tested: support for Bitcoin, resistance for the DXY. So these are two things that we can see that are confluent with each other. Let's also take a look at the NASDAQ, because as I mentioned, Bitcoin tends to follow the NASDAQ, and that's especially true during bear markets. So let's pull that up. Here I have the weekly chart for the NASDAQ pulled up. This is the tech index for the equity market in the United States. And just like in crypto, we've seen a very bearish past 5 or 6 weeks and several months if we go back a little bit further. But the confluence here that I want to point out is that just like the past two indicators that we looked at, just like Bitcoin and the DXY, the NASDAQ is also testing its support level right now. This is a very significant level. This is a level that was tested back in March of 2021 over a period of over a month, and ultimately held. And holding this level approximately at 12,700 led into the next leg up. So this is pretty straightforward, not much more to say about it, but it's important to note that this confluence is occurring. Once again, we have, just like Bitcoin, we see the NASDAQ testing support just as the DXY is testing its resistance. And so here we have more confluence. Let's look at one more source of confluence here, which is the stablecoin index. So let's pull that up. So here I've got USDT dominance. This is not all of the stablecoins in the market, but USDT is the most dominant stablecoin. And so it's a reasonable proxy for looking at how much cash are people holding on crypto exchanges, basically. How much are they holding in preparation to deploy into crypto assets? That's essentially what we're looking at here. In alignment with the other indicators that we've been looking at, we see some pumpage that's been happening over the past 5 weeks. People have been selling their crypto for USDT, which they're now holding and waiting to use. And the question is, are they going to redeploy their stable coins back into crypto assets, back into non-stablecoin crypto assets soon, or is it going to take longer? And is the stack potentially going to grow in a way that would be bearish for Bitcoin. We can see that, just like all of these other indicators that we've seen, the USDT dominance is testing a level that it struggled with on a number of occasions in the past. Beginning all the way back in September of 2020, more or less. Then again, this level at about 5% was visited in May of 2021 and repeatedly over the subsequent months before people began to buy much more aggressively. And that lasted until about November when the market went into free fall and people were selling their crypto for stable coins. And since then, we've been really in a consolidation between about 3.8% and about 5%. 5% has not broken yet on the USDT dominance. And just like we saw with the DXY, you can interpret these two indicators in somewhat similar manner. I mean, they both index how people are evaluating cash relative to risky assets. We could expect to see a rejection and a pullback from this level. This might indicate the fact that it's revisiting this important resistance level, that people are getting ready to redeploy their cash into crypto. Just like with all of these other things, what would invalidate that expectation would be a weekly close beyond these levels. So on the DXY, we saw that 104 is a critical level. And if we saw a weekly close above 104, that would be very bearish for risk assets. Similarly, if we saw a close on the weekly above about 5.5% for USDT dominance, that would suggest that people are not ready to redeploy their stablecoins back into crypto. And in fact, they're continuing to sell and continuing to stack cash. So the DXY and the USDT dominance are both at critical resistance levels. And their behavior here is going to tell us a lot about what to expect for the coming period. So these are all confluent. They're all visiting really important levels. We're going to get some important information soon about the trajectory of the market. We've been within ranges over the past 5 or 6 weeks, but now we have reached the boundaries of those ranges on pretty much everything. So to round out the picture here, I want to pull up one other indicator, which is a bit of a different kind of indicator. This is an on-chain metric that looks at active addresses, the change in active addresses specifically, and how that is related to the price of Bitcoin. And the goal here is to try to identify divergences between them, because when you see that, let's say, active addresses is moving to the downside while price is moving to the upside, that's a bearish divergence that indicates that the actual use and interest in the network is not keeping pace with the price action. And in the opposite direction, when we see that active addresses are moving to the upside while price moves to the downside, that's a bullish divergence. It indicates that the price is not keeping pace with the underlying bullish fundamentals. And that latter situation is what we're seeing right now on this chart. If we just look at this across time, first of all, the dark line here up on the top is just the price chart for Bitcoin. But here on the bottom is what we really want to pay attention to. This yellow oscillating line is the 28-day percentage price change. So over the past 28 days, what percentage change in Bitcoin's price has been seen. And that's plotted relative to this y-axis here on the left, these percentages. So right now we're seeing that the 28-day price change is about minus 17%, or about minus 16%. But this is overlaid on top of these red and green dotted lines. And these are standard deviation bands of the active address change. The faint gray line in the background, which isn't that important to pay attention to, is the actual percentage change in active addresses. But what we really want to see is the standard deviations of them. So what's the range, and how far away is a price action from kind of agreeing with the change in active addresses? Generally, the simple way to interpret this graph is that when we see price reaching the upper boundaries of the active addresses change percentage, especially when it spikes well above it, that indicates that the price has gotten out ahead of the underlying fundamental usage and interest in the network, and that it's unlikely to be sustainable. And generally that coincides with tops. So, this enormous spike back in January of 2021 um, did indeed foreshadow the top. It wasn't the actual top. The price did continue to move up, but that represented a divergence because the price kind of grinded up, made a few more marginally higher highs, while the change in active addresses began to decline. And in hindsight, we can see that that was a bearish signal, and indeed it predicted the end of that bullish phase. On a smaller scale, we've seen that happen more recently as well. These spikes up back in August of 2021 and the end or the middle to the end of October of 2021. But we can also equally see that that is predictive to the downside. So, in June of 2021, when the price declined substantially and relative to the change in active addresses was very undervalued, we saw that that was an early indicator. It actually called the uptrend before the uptrend began. So this has the potential to be a leading indicator, as we can see back in June and July of 2021. There are other examples of this too, but let's just skip to the present because we can see that in the present, by this metric, the price of Bitcoin is currently undervalued. The discrepancy between the actual interest in the network, how much people are using the network, is bullish. It indicates that the price of Bitcoin is not actually mirroring the network's actual value. So this is just another source of information that suggests to me that in the short to medium term, there's reason for optimism here. There are also clear criteria for invalidation. Like I said, if the DXY blasts through 104, if Bitcoin loses the 35K level, if USDT dominance closes weekly above about 5.5%, if the NASDAQ loses the level at about 12,700 that it's currently testing, all of these things are likely to play out in correlated manner, and those would invalidate the thesis. But the thesis right now is that the risk assets are testing support. The risk off indicators, meaning DXY and USDT dominance, are testing their resistances. And we see that the fundamentals of the network suggest that it's undervalued here. So caution is always necessary. We don't want to go all in. A dollar cost averaging approach is always advisable, meaning putting in a little bit at a time so that you get a good average price. But I'm very skeptical of the people right now who are calling for much lower prices in the short term. Doesn't seem very likely, but we'll find out soon enough. So I hope you guys found this useful. Thanks for watching.